financial repression. So myself and other experts like Gordon T. Long and Chris Martinson and others have been covering financial repression for a long time. However, I have not seen a lot of people actually try to run the numbers and quantify, give a good estimate on exactly how much is being wealth transferred, how much in investment income is being stolen from savers, stolen from retirees, stolen from pension funds who should have gotten that interest income, and instead these too big to fail governments, whether it's the US government, Japan, the European Union, are siphoning off the interest income for themselves. So Wolf Richter of wolfstreet.com, he did a podcast recently. It was a couple days ago on Thursday, August 1st. And the article got put on Zero Hedge, the podcast and the article with the transcripts. It's for free, the podcast, I guess. I think he charges also, but this particular podcast is free. So it's called The Giant Sucking Sound of Financial Repression. I'll read part of it. According to the numbers he ran, in the U.S. alone, it impacts nearly $40 trillion with consequences for the real economy. And interest rate repression or financial repression, other central banks, including the European Central Bank and the Bank of Japan, push their policy rates below zero. This, in addition to vast asset buying binges by those central banks, produced, at the time it was 13 trillion in negative yielding bonds. Remember a couple months ago I did a short video on that. Now, according to Jim Bianco, who is a global macro researcher and money manager, the number of negative yielding bonds is up to 14.5 trillion. So remember when I was showing those graphs, the charts of the negative yielding debt, that it was about to go parabolic. It had just breached the 13 trillion number, and it looked like there was no hints of it stopping. It's now at 14.5 trillion of global negative yielding debt. And the U.S. hasn't even gone negative yet, although the 10-year U.S. Treasury is down to 1.855 because there is lots of flight capital coming in from emerging markets. There is lots of flight capital coming in from the European Union. There is lots of flight capital coming in from Japan. There is lots of flight capital coming in from China here to the U.S. market still. And in addition to that, you have the people copying professional money managers who are copycats, copying Stanley Druckenmiller, who has sold his stocks and is going long U.S. Treasuries. Oh, okay, let me just turn off the phone really quick. I don't know why that happened. Okay, so after the stupid distraction, we are back. Just ridiculousness by these governments. So the Wolf Richter article, I'll only read part of it. I'll attach a link in the information section if you want to read the whole thing. So he runs the total here, and he gets to around $39 trillion. Let me talk about the numbers here. So how much money... So now we have the situation where short-term treasury yields are low and long-dated treasury yields are even lower. How much money are we talking about here? Let's see. There are 22 trillion in treasury securities. They're held by individuals and institutions, including insurance companies, pension funds, and the Social Security Trust Fund. Then there is high-grade corporate debt. The category of AAA to single A rated debt is about 3.3 trillion. These yields have been pushed down too. Then there are 3.8 trillion in municipal bonds outstanding. Many of them trade below US Treasury yields. For example, the GO bonds of California, which is not exactly a paragon of fiscal rectitude. During trading last Thursday, the California 10-year yield was only 1.76%. This was about 1/3 of a percentage point below the U.S. Treasury 10-year yield of 2.08% on the same day. Then there are 9.4 trillion in savings products, mostly savings accounts and certificate CDs or certificate of deposits at banks. There are also about 3 trillion in checking accounts, payroll accounts, etc., but they're not included here. These are just savings products. So he adds up these categories and they're about 39 trillion according to him. A 1% reduction in interest spread across the board of just these four categories amounts to nearly $400 billion a year that the holders of these products are being deprived of. So a 2% deprivation difference in interest yields across the board takes nearly $800 billion a year in income from savers, current and future retirees, and fixed income investors, and hands this money to borrowers, mainly to big governments, so they can continue to run the status quo, continue the waste, fraud, corruption, and abuse, and misallocations of capital. And this amount of interest income, it prevents reinvestment of savings. It prevents people from consuming, which means that they have to consume less, which will ultimately hurt a lot of the consumer businesses like retail. It will hurt retail even further. So there are a lot of negative consequences to financial repression. So props to Wolf Richter for actually running the numbers and coming up with an estimate. And according to his estimate, a 2% difference there starves American investors and savers and retirees of $800 billion per year. A 1% is $400 billion. And that is just the US. That's not even counting Japan, which has been doing financial repression for longer than anyone. In the past, financial repression was only done in wartime. Okay, and it was temporary. But these governments are so stupid, and they will not cut government spending because it buys the politicians' votes. And they're in the U.S. There's and European Union. There's so many people on welfare programs. There's also massive military spending too. So it's not just welfare; it is welfare and warfare. That is the major problem. But if you look at the amount of total money that's being stolen through financial repression, if that $800 billion per year is accurate, that is it's a little bit lower than what the U.S.'s national deficit is growing at, and the interest payments on national debt are a little bit above $600 billion. And eventually they're going to go to $800 billion per year, just the interest payments on the national debt. The principal is never going to be paid off. No one seriously thinks the principal will ever be paid off. But the politicians, both Republican and Democrat, in Congress here in the United States, they do not care. Most of them do not care. Almost all of them do not care about the national debt. Some of them pretend to, but they really don't care about the national debt. I've even heard some off the record stuff from some of them. It's ridiculous. They don't care. And they only really care about interest payments on the national debt. So as long as the interest payments can be made, and this is why financial repression is being done, so the governments can keep growing their debt in the European Union, the United States, and Japan. And even though the size of the national debts are growing, they're manipulating interest rates lower so their interest payments don't explode. But then you get to a total trapped endgame scenario like Japan, where a 1% increase in interest rates in Japan would totally wipe everything out. They are not stupid. This is by design. Yes and no, but they're also going to destroy things. They're actually destroying the banks, Sean. So here's comments, and I'll prove it to you. There's articles that are coming out that the bankers don't even like this now. Okay, the actual bankers in the European Union don't like this. There's a Bloomberg article that just came out a couple days ago by Brian Chapata. Negative yields could be the death of bond markets. And the CEO of Credit Suisse, speaking to CNBC following the bank's second quarter earnings report, said, quote, "I am not a great fan of low interest rates. As a great believer in the importance of savings in the economy, subsidies to debtors and penalties for savers, I think in the long run harms the economy," end quote. Tijani Tiam is his name, the CEO of Credit Suisse. I'll put a link to this article. It was from a couple days ago. So, and then there's articles coming out about how Deutsche Bank, this was from 3 or 4 days ago, a CNN business article, how negative interest rates helped destroy Deutsche Bank into a disaster, how it made things worse, exacerbate the problem. So the people who are saying this is intentional, the collateral damage, the side effects are it's destroying the banks. So yes, maybe they are doing this intentional to save the governments, but then they don't want to destroy the banks. So the banks are being killed. And the European Union is first on the block. The European banks are in the biggest trouble. The European government debts are ridiculous. Look at the yields on Greek debt. Look at the yields on Italian debt. They're lower than even the US. But there is no real demand for these government bonds. So there will be a lot of flight capital coming in from other countries into the United States. And this is why, in my educated guess, I think things are setting up very similarly. And Martin Armstrong has talked about this too, to a certain extent, not in the exact same words. And Ludwig von Mises has talked about this in the past as a crack-up boom, why there will be a lot of flight capital that will be coming into the US, similar to the 2 years, give or take, prior to the October 1929 crash. So what happens when the banks fail? It could be a combination of bail-ins and bailouts. The other story I wanted to talk about is UBS Switzerland. It was a few days ago that was announced that UBS is going to start charging their richer clients with a higher negative minus 0.75% interest rate. So if they have, I think, let's see the exact number. I think it's 1.8 million euros of savings at the bank. They start getting charged a higher fee to keep it there. And obviously what's going to happen is the smarter money people are going to keep less money inside the banking system. There's going to be, because you're going to get charged so much to keep money inside banks that you're not going to want to keep money in banks. So they're thinking that they can corral money, that they can trap it there, that they can sterilize it in banks, but it's going to create the unintended consequence of bank runs. So people are going to pull their money out faster the more these European banks try to charge to keep the money there. And then that's going to be good for gold, in my opinion, and it's going to be good for Bitcoin. If you're going to get charged almost 1% to just park money in a bank, they're not going to pay you to keep it there, and you have a good amount of savings, there's not going to be much point to keep it there. The money is going to leave the banking system. People would rather have zero and not get charged. So this financial repression, it is devastating. And yes, it may be being done intentionally, but it's not saving the banks. Maybe the goal of the people doing this was to save the banks, but it's not helping the banks. The banks are getting killed too. And they're admitting it. So that quote from the CEO of Credit Suisse, I think the guy actually understands. All of this stuff is just accelerating now. We're at ridiculous amounts of negative yielding debt. It could get even worse once the U.S. starts to. There's a lot of people at the Federal Reserve that want that. A lot of these eggheads, these PhD economists who have no real world experience whatsoever, who believe that there is no inflation, who believe that there needs to be more inflation, and financial repression, stagflate, and tax and lie are all part of the game. There's so many scams. I mean, I don't know if I'd want to buy and hold Bitcoin for many, many years, but if you're going to get charged a high interest rate to keep money at a bank, now, and Chinese government may do a RMB devaluation, no wonder why Bitcoin's popular in China. People may not buy and hold Bitcoin, but they're at least using it to get their savings out of a bad currency like the euro and the RMB. Bill says inflation is a hidden tax most people don't understand. Exactly. Inflation is a tax because it destroys your savings. It destroys the purchasing power of your savings. It's a stealth tax. John Maynard Keynes said not one person in a million can understand or realize inflation that is happening. It destroys the value of your savings. So here's a hypothetical situation. So 20 years ago, if you had $1 million or $2 million in savings in the bank, you could live off 5 or 6% interest. You could live a halfway decent life with like $30,000 or $40,000 in savings from that $1 million or $2 million. And you could put it into US Treasuries and make 5 or 6% and not spend your principal. So you could live frugally off your interest payments of the 5 or 6% off the $1 million or $2 million savings. You can no longer do that. To earn the same amount of interest payments there for like $20,000 or $30,000, you need more than $5 million. I think it might be more, almost $10 million now. So inflation is a stealth tax. It steals the value of your savings. $1 million from 30 years ago, 40 years ago is not worth nearly the same purchasing power as $1 million today. I think Brexit is enormously overrated. I don't think so. There's all these people claiming that Brexit's going to do immense damage to the global economy. I don't think it'll do that much damage at all. England's economy is not super large anymore. I don't think Brexit is really that big. There's a lot of people in the gold community and the alternative media that think that Brexit's going to cause immense damage. I do not think so. The larger economic landmines are the emerging market dollar-denominated debt, the debt problems with European banks and derivatives problems with European banks, the balance sheets of European banks. European banks have bad derivatives, bad loans to emerging markets, and European government bonds that are a big problem. And that's why the European Central Bank has stepped in. Because there is no real demand for European government bonds, especially at those yields. And we have not seen enormous flight capital yet out of Europe, I suspect. And this is because professional money managers, they cannot hold cash. So if you're not familiar with how professional money managers act, the more a professional money manager holds cash, the more likely he is to get fired or have his investors pull all their money. So this is why professional money managers have to buy something, and this is why they copy each other like crazy. Because they're trying to save their careers, and they would and they would rather lose the exact same amount of money as the guy to their left, the guy to their right, etc., or woman to their left or woman to their right. There's more women money managers now, but they do not, even though it might be more prudent to do so, to hold 10%, 20% cash waiting for a stock market crash or something like that. If you're a professional money manager, like a hedge fund manager or a bond fund manager or a stock mutual fund manager, you cannot hold cash. You cannot, if you hold a certain amount of cash, basically you're risking career risk, you're risking never getting a job again, you're risking getting fired. Well, Warren Buffett at this point has a reputation, so he can do what he wants. I mean, he's a very old man. If Warren Buffett was in his 30s or 40s, I don't think he would hold this much cash. Let me put it that way. If Warren Buffett was like the young, hotshot professional money manager who had raised like $5 billion to manage, and he was like the young, good-looking hedge fund guy on the cover of all these financial magazines, he would not be holding cash. But he has a long reputation of making people money, and that's why he can do it. More criminal activity in the Fed notes than any other denomination. Yeah, there's criminal activity everywhere. Okay, guys, well, I'll attach links to these articles. I have the Wolf Richter podcast. I have a couple articles on Deutsche Bank and the quotes from the Credit Suisse CEO and the Bloomberg article, How Negative Yields Could Be the Death of Bond Markets, and a couple articles on UBS Switzerland now charging their clients who have at least 1.8 million euros in deposits at their bank accounts. So this is going to get even more ridiculous. This is going to get even crazier. And I suspect, my educated guess is that as these governments do more and more crazy things, more flight capital will continue to come to the US. And that is because these professional money managers in other countries, it is on a relative basis. They will look at European bond markets and European stock markets and be wary of those and say, I'm going to buy US stocks, I'm going to buy US bonds, I'm going to buy US real estate. And I think you're already seeing that to a certain extent for the last, 7 or 8 years, and it's going to accelerate probably in the near future. Okay, bye for now.